Hi everybody, welcome to our session. This is session 6 of Stocks Zero to Hero. I would guess that we're about 2 or 3 sessions from the last session of the series, so almost there. We covered a lot. Before we dig into the session, I wanted to just tell people who may have missed yesterday's video, but we are doing another session for beginners. And while the content is much more basic than what we're covering in this course, it is also much more important. And I think for a lot of us, it's very easy to lose the forest from the trees when we start digging into the details of finance. So I highly recommend that even people on this call and our more intermediate and advanced audience also take the time to just view these as quick refreshers. So they're all available. All our videos will be available on the YouTube channel in case you missed the live sessions, etc. But I think it's good to get a refresher in terms of how simple finance can really be. Which we can often forget when we're digging into the weeds of individual stocks, etc. So with that preamble, I think let's get started. We have a longish presentation today. I don't know how quick it'll go, but in terms of slide count, it's above the last few. So hopefully we still have some time for Q&A, etc. So please keep the questions coming into the chat as we go through, and we'll do our best to cover them. And for any unanswered questions, we'll deal with them via email. So with that, let's dig in. Okay, so last time in session 5, we understood the balance sheet. We understood what assets were. So assets, again, were the things that a company owns, and then liabilities were what it owes. And the difference, or the wealth of the company, was essentially net worth, just like for a person. We analyzed Britannia's balance sheet and it looked very clean, right? There was not a lot of money. In fact, zero almost that they owed to lenders or anything like that. Lots of assets and also lots of cash and investments. So the balance sheet was very, very clean. And we laid the groundwork for what we're going to do in today's class, right? We discussed how we're going to analyze Britannia versus its peers, its competitors, companies that look like it. So we can start figuring out how it compares relative to other options that we have to invest in the FMCG sector. So this class will look at some of that data, and we'll also do a quick intro into the cash flow statement. And then we're going to understand Britannia's business model and strategy in a little bit greater detail, which again is from the annual report. Then we're going to conclude the session by adding more questions in our question list and also looking at the questions that we've covered now with the data and analysis that we've done subsequent to building the question list. So a lot to do today, so let's get started. Okay. So like we did with the income statement and balance sheet, we're going to take a look at the cash flow statement. So here we just have the raw cash flow statement that you can find in Britannia's annual report. It's, I think, one page after the income statement and balance sheet for those following at home. Essentially, the cash flow statement starts with, as the first line, the amount of profit generated by the company from the income statement, right? So that's where it begins. It said, okay, in this year, the company generated, in the case of Britannia, I know the numbers are small here, but for those not looking at home on their own annual report, I'll just read the number for you. It's 1445.2 crores, right? So that's the profit before tax it generated. And then what the cash flow statement does is it tells us exactly how much cash Britannia added during the period. And all the lines in between, all these lines here, basically tell us what happened to the rest of the cash. Where did Britannia spend the rest of the cash and how much actually stayed in the business, right? So this is a way that investors can get insight into where the company is investing, how much it's paying as dividends to shareholders, etc. So it's a useful statement. In my opinion, of the 3 statements, the cash flow statement tends to be the one we use the least in stock analysis, but it can be very helpful also in certain cases. So it's good to know about it, and it's good to spend some time familiarizing yourself with it. Okay, so let's understand some of the key lines for Britannia. So what I've done here, similar to the income statement and balance sheet, I've just reduced it to the key lines that are important for me as I'm analyzing the business. And also, therefore, we can make it cleaner and expand the font so everyone can follow at home. So in the cash flow statement, we have two periods, 2018 and 2019. Net cash from operating activities is essentially how much cash the company generated through just running its business, selling its products, paying its employees, paying its other costs, how much cash was left after all of that. So we can see that in 2018, Britannia generated 1182.6 crores of cash. This actually went down to 1113.7 crores of cash in 2019. So we already have an interesting question, right? We know Britannia's earnings went up in 2019. Why did the business generate less cash? So that's one of the questions we're going to add to our question list and explore in the next class. The next thing we have is the amount of cash that it used in investing activities. So that's this section here in light pink. So this tells us how much cash Britannia essentially put into investments. Now, investments can be several types. So here's one line that says acquisition of PP&E. So you can see that Britannia has invested about 315 crores in PP&E. Now, what is PP&E? It's plant, property, and equipment. So we know that Britannia is expanding into new product categories, right? We briefly discussed that, I think, when we first opened the annual report of Britannia, and we'll discuss it more in this class today. But maybe this money is being used to open new factory lines for those new products, right? They're investing money in equipment and property and plant to perhaps build factories that can produce new types of products. We also have a line here that says purchase of investments. So what is that? So Britannia spent another 315 crores of its cash that it earned on buying investments. So this is essentially on the balance sheet. You'll remember there were cash and investments. So this is how much cash Britannia decided to buy more investments with. So for some reason, Britannia is keeping a lot of cash in the company. And instead of investing it back in the company, it's choosing to buy securities of other companies or putting it in a fixed deposit, or we need to understand what it's doing with this money. So this is a question we're going to have as we look at competitors. Is Britannia keeping more cash in investments than its competitors are? If so, this could be an area that we may need to dig in further and understand why it's doing that. Or is it standard in the FMCG industry to keep a lot of cash and investments in the company? So we're going to answer that question in this session as well. Then you have this other cash used in investing activities. So this are miscellaneous things that sort of, also fall in this bucket of investments into the company. But the real key ones that we look at are these here in the case of Britannia. So now we move to net cash used in financing activities. So this tells us how much cash went in or out of Britannia in regards to its decisions on how to fund itself. So if, for example, Britannia borrowed money from somebody, we would show that borrowing being a source of cash in this section. Or if, for example, Britannia decided to pay back some of its cash to shareholders, remember, it can decide to give some of its earnings back to shareholders in the form of dividends, that would also show up in this section. So therefore, that's what we see here, this dividends paid line. That is the amount of cash that Britannia decided to pay back to shareholders. So we see that in 2019, Britannia paid back 354 crores of cash to shareholders. And if we calculate this as a percentage of the amount of cash the business generated in total, which I show here, we can see that roughly 1/3 of all the cash flow that Britannia earned as a business went right back to the shareholders as a form of a dividend, right? So this is telling us that Britannia has decided that a lot of its cash flows are going to go back to the shareholders in the form of dividends. And the last line is how much the cash changed during the year. And that's just equal to A plus B plus C. So in other words, how much cash the business generated plus whatever was used in investments plus whatever was used in financing activities. And all these brackets here mean negative numbers, right? That's an accounting convention. Some of you may not have seen this, but that just means a negative number. And so this means that they've used cash in buying more investments. They've used cash in paying dividends. There could also be cases where these things resulted in cash. If they were selling investments, we would see that be a positive number. Okay, so that's essentially some of the key things I picked up from the cash flow statement here in Britannia. So sorry, 1 second. Sorry. Oh. Someone just told me that we're having some technical difficulties with the video. Let me see. Okay. Anita, we're having some technical difficulties with the video.
If there's someone who can't see the video, can you just post it on chat?
We're sorry if you can't see the presentation. I'm not sure why that is. We were having a bit of technical difficulties with Zoom.
I think someone said that they suspect that there's some Zoom issues. Is there anyone else who can't see it? Please post.
Okay, we are seeing, let's see in the chat how many people this is impacting. It's working fine in the phone app, but not in laptop. Okay.
So I think just continue because we can.
Okay, we're going to post this on YouTube as soon as the session's over. So hopefully people that can't see the video, as soon as this is done, will be able to see it on the video. I'm really sorry about this glitch. We'll post it as soon as possible. And Anita will send a message on the WhatsApp groups when that's been posted. But how long would you estimate, Anita, for it to get posted?
1 hour.
So a max of 1 hour. So let's say 6 p.m. You'll be able to find the video. Okay. So we're gonna just continue on. So for those having trouble, if you can open it on your phone, it sounds like that's a bit of a workaround around it. Okay, so let's continue. So what are our key questions from the cash flow? We discussed this. So, okay, let's move to the next slide. Okay, now what I did to basically compare Britannia to peers, I picked 4 companies, okay, and there are more companies out there that you can compare it with. I just wanted to give you a flavor of how this kind of analysis goes. I picked 4 companies from the FMCG world that were pretty similar to Britannia in being an FMCG company, having similar characteristics, etc. And I calculated a lot of the same ratios that we calculated for Britannia for those companies. And I laid them all side by side. So here I've looked at sales CAGR, so FY17 to FY19, gross margin, operating margin, and earnings per share CAGR. So before I dig into the charts, I want to make sure everyone remembers what these items are. So sales CAGR, again, is the average growth rate of the company's revenue, which is sometimes called sales also. So top line, how much it's selling to customers, the average growth rate over the period FY17 to FY19, right? So that'll give us a sense of Is the company managing to sell products to more and more customers over time, or is it having trouble selling more and more products? Now, the gross margin, if you remember, the gross margin was the cost of producing a product, right, taken out from the revenue. So how much is left of profit when you take out the cost of producing, right, and dividing that by the revenue, right? So that is telling us how much pricing power a company has. The higher the gross margin, the more the gap between the price that they're charging customers and the price that it costs them to produce the product. So that's telling us, in a sense, how much customers are willing to pay for their products relative to the cost of making those products. The higher the gross margin, the more pricing power, in a sense, a company has. Then we go to the operating margin, right? The operating margin is telling us how much money is left after you take out the business overheads of the company. So this is essentially the amount of profit left in the company before taking out things like interest that it owes to lenders and all those things, right? But and taxes. So this is kind of your fully allocated costs of your company taken out and how much money is left over. And then we have the earnings per share CAGR. So like we looked at for the top line for revenue, the growth rate, we're also looking at the growth rate for the earnings per share. And remember, as investors, what we really care about in a big way is what we think that earnings growth is going to be for the next whatever years, because we're investing for the future and we're getting a piece of the company's earnings when we buy the stock. So this is what we really, really care about as investors, but we also want to see how the company gets there. Is it gross margin? Is it operating margin? Is it sales going up? So that's why we're looking at all these things in concert. Okay, so now let's see how Britannia is doing versus competitors. And by the way I did this and put this together was exactly the same way we put together the analysis on Britannia. I opened up their annual reports, I read through the financials, and I put in these numbers. And I obviously did it quicker than I did with Britannia because I'm not trying to study these other companies. I'm just trying to get quick comparisons, just make sure how it stacks up versus competitors. Now, there's some shortcuts that we'll discuss in the last session that can make this a little easier for people. There's some tools out there, but I recommend beginners actually go through the work of doing it on their own. I still go through the hard work of going through annual reports myself because I like doing it that way. I don't trust other people's numbers. I want to see where the numbers are coming from myself. Okay. So with that preamble, let's actually look at what the data is telling us. So if I look at the sales CAGR, again, the growth rate of sales, average growth rate, I can see that Britannia averaged a growth rate of revenue of 9.95%, right, over this period. And if I look at Nestle, HUL, Dabur, and TCPL as Tata Consumer Products, you can see that other than Nestle, right, they're all lower, significantly lower than Britannia. So it looks like Britannia is doing a very good job of selling more products over this period, right? So we're going to want to understand why that is. What is driving their sales growth? How are they able to sell more? And we'll get a little bit of insight into this later in the presentation when we understand the strategies. But it looks like that's a very good sign that the company has the ability to grow its sales if it's sustainable in the future. And one of the other things I like doing is calculating the average of the peers. So the peers, if we just take the average of Nestle, HUL, Dabur, and TCPL, we see the average sales growth rate was 6.2%. So Britannia is doing much better than the average. Okay, now let's look at gross margin. So gross margin is a very different story, right? Now, gross margin again tells us the pricing power of the company. So Nestle, HUL, Dabur, and TCPL are all operating at higher gross margins than Britannia. So what does this mean again? This means that Nestle, HUL, Dabur, and TCPL are able to make more money on every sale when you take out the cost of producing that product. So that's telling you that for some reason, they're able to charge more to the customer for their cost of production. Now, this could be for a variety of reasons. It could be because of the product mix. Maybe Britannia is in categories that just cost more to produce and customers can't afford to pay more. It could be because Britannia's brands do not have as good brand power as some of the other ones. Like, let's take, for example, Nestle, right? We know one of Nestle's big products is Maggi noodles, right? Now, Maggi noodles cost almost nothing to produce. Probably they're just a bunch of wheat and some, spice blend and some cheap packaging, and the brand equity is tremendous. So it's not surprising that Nestle is leading the pack when it comes to margin, because at the end of the day, people really like the products, and it doesn't cost much at all to produce the products. Um, so this is one thing that we're going to want to understand with Britannia. Why is its gross margin so much lower than some of the other FMCG companies? Now, keep in mind a 40% gross margin is still pretty good, but clearly some of their peers are able to do better. Okay, let's look at the operating margin. Okay, so here we're seeing again on the operating margin, Britannia is not the lowest, but the second lowest in the set of FMCG companies we're looking at. And that probably is a function somewhat of gross margins being lower. But, it looks like Britannia is able to, is relatively more efficient because it was, for example, 10% lower than the peer average on gross margin, right? The peer average was 52 and they were 41. Yet when you look at operating margin, it was 18.9 versus 16.09. So that's only a difference of 2.9, right? Or 2.8. So it looks like Britannia is pretty efficient. They're not losing a lot more on the operating margin. In fact, they're doing pretty okay on the operating margin. Then if we look at the earnings per share CAGR, how fast is Britannia growing its earnings per share over time? We can see that the peer average was 12.9% and Britannia is growing at 15.23%. So this is telling us that Britannia is actually growing their earnings faster than the average rate of the FMCG players. So this is a very good sign. So let's continue. Okay, so now let's go to the balance sheet metrics. So what did we care about on the balance sheet? We cared about understanding how much cash and investments these players were holding. Remember, one thing that stood out to us was, why is Britannia keeping so much cash in the business? It could decide to pay this out to shareholders. Instead, it's keeping it in the business. So is this standard in FMCG, or are they doing something non-standard? So this was a bit comforting on that fact. So when I looked at the peers, almost all of them had significant cash balances. And the way I looked at the ratio was, I said, okay, I want to get a sense of how much cash the company is keeping relative to how big or small the business is. So, so I used the company's revenue or sales as a proxy for size of a business. The business that sells more product is bigger. And that allowed me to compare the cash balances of different companies. And as you can see, Britannia is actually below average in terms of the amount of cash it's keeping. So this is no longer a red flag. I mean, it's still a curiosity to me why these companies are keeping so much cash on the balance sheet, but it looks at least like it's standard in the industry, right? But I am going to want to understand what these cash investments are exactly. What is the holding that these cash investments are in? Okay, the other thing I looked at was borrowings over total assets. So almost all of these players operate with very little borrowings. The only exception is Tata Consumer Products, which has a higher degree of borrowings. But even that is not a very, very high level of borrowing. So I didn't look at the other two metrics because they weren't relevant. None of these players really had any leverage. Leverage means borrowings. But if you wanted to look at companies that were leveraged, and we had a little bit of questions around this, I recommend you look at two things. So one is the debt over the operating income. So that's how much they've borrowed over how much the company makes every year. This is going to tell you how long it's going to take for the company to repay that borrowing, essentially. So if I've borrowed let's say 10 crores, right? And I earn 1 crore a year. If I took 1 crore in savings every year, if I took that 1 crore and I repaid the loan every year, it's going to take me 10 years to repay that loan. So that gives us a sense of how much borrowings relative to earnings a company has. And you want to look at the operating income there, because that's the earnings that are available to repay your borrowings. Because you don't want to look at gross profit, but operating income, because gross profit, you still have to pay your salaries, etc., etc. The other thing you want to look at is how much is that borrowing costing you relative to how much the company is earning. Some companies may be borrowing at a 12% interest rate, some at an 8% interest rate. So if we compare the interest rate, the interest cost rather, divided by the amount of cash there is to repay that interest with, then we'll get a sense of how much risk there is in the business that it could miss an interest payment or not. Again, this is not relevant for this sector. Unfortunately, there's no borrowings here, so I can't show you how this analysis works. In an advanced session in the future, we'll look at leveraged companies and see how we can assess the risk in those companies. Okay, so that comparison analysis was helpful. So what are our key takeaways from all that, right? So Britannia does seem to be getting a lot of sales traction. Its CAGR was the highest of the FMCG players we looked at, but its margins are low. Does this reflect poor brand equity, structural differences in the business? Is there a chance that they could expand their margins over time, right? Because if they're under earning, could they actually push these margins up closer to their peer average? So we also got comfort on the cash plus investments. It looked like it was high to us, but looks like it's in line with the other FMCG players. Also, none of the peers were borrowing much, so that also made sense. So now we have a sense of how Britannia compares to others. And we're going to come back to this analysis at the very end when we start deciding what PE multiple Britannia deserves. So just park this for the time being. This analysis will be very, very useful for us when we start looking at valuation, but we're going to do that at the very end. So I want to jump topics a little bit to now understanding some of the qualitative aspects that we can pull out from the annual report. So when doing this, you look through the annual report for sections that give you any detail on who the company is, what its products are, how it sells its products, what its strategies are. So I found some areas of the annual report that had some good information on this. So I've called them out here on the slide. So pages 1 to 17 and 27 to 29 are those sections of the annual report that I recommend reading to get a better sense of Britannia and its strategies. So you guys should do this too on your own. But some of the key findings that I had after just reading the annual report. So who is Britannia, right? So they had a great chart, which I've shown on this page, that shows you all the products that they kind of offer and all the brands they offer it under. So this is great to give you an understanding of what all the company sells. And then you can ask yourself as a consumer, how good are these products? How good are the brands that they have and all those things? So that's one very, very good analysis you can do. The other thing is they told us in the annual report what their legacy product areas are. So what are the product areas that the company has traditionally operated in? So they call those out as biscuits and cookies, cakes, breads, rusk, and dairy products. They also told us what their new product areas are. So these are the ones that they're expanding to and want to strategically enter. So these are newer categories for them. So the ones they called out were salted snacks, milkshakes, croissants, and cream wafers. So you're going to want to understand now when you're saying, is Britannia a good investment or not? Do you think this company can enter into these categories successfully, right? Because they're going to try to do that. Do you agree with this strategy or not, right? And we're going to want to see data to see how well are they doing and how well are they not doing, right? So we're going to see if we can pull out some of the data on that. I looked in the annual report. There's not a lot of data in terms of category level sales, etc. But we're going to see other ways you can get a sense of that. I'll do my best to sort of do some jugaad so that we can get a sense of how these products are performing. Okay, So then how does it do marketing? Very traditionally, it goes through TV, radio, social media, digital campaigns. You can tell that brand equity is pretty important for the company. It sells its products internationally, but the company doesn't really do much internationally. When you look at its sales, you can see page 107 of the annual report. Only 6% of its sales are from outside India. So the way I think of this company is pretty much a domestic company. 90 to 94% of its sales are generated in India itself. So that actually makes it an easier company to understand. We don't need to worry about different geographies and how well it's doing in those geographies, etc. Okay, the next thing that I focused on in the commentary was what are they trying to do with the business? And our job as investors is going to be, do we agree with the strategy? What do we think the chances it's going to work are? And that's going to play a key role in whether we invest or not in the company, right? So here's what they said, category by category. So biscuits and cookies. Okay, they said the category is one of the fastest growing in FMCG. Consumers skew towards value biscuits. Britannia's strategy is to drive penetration. So basically, they're saying here that in the biscuit category, it's growing very fast, but most customers opt for cheap biscuits. And Britannia offers premium biscuits. So they're trying to upgrade customers from cheaper biscuits to Britannia's more expensive biscuits. And so that's their strategy. So they're trying to gain share there from cheaper alternatives. So a big part of that is, do you think Britannia's biscuits are worth the premium, right? They're trying to convince customers that these are better biscuits. Do you really think they are better biscuits? And do you think that will work? 42% of the market is rural, but Britannia under-penetrates rurally. So Britannia is trying to increase its market share in rural regions. So do you think they'll be successful doing that? With a premium biscuit brand, will they be able to sell at higher price points in the rural region? So that's another thing to think about as you evaluate Britannia as an investor. Also, they called out gaining share from local producers in the north and east of India. So apparently in the north and east, there's some local producers of biscuits that are very popular. And Britannia, part of their strategy is to gain market share at those local producers' expense. So do you think they can do that also, right? Then cake. So cake, they're trying to expand the size of the cake category. It's still relatively nascent in India. So how well do you think this category will perform? Do you think packaged cakes will take off? Rusk, they're trying to gain market share from unorganized players. Then in the new categories, this is interesting. They said they're trying to achieve strong positioning by offering disruptive and differentiated products at competitive prices. Now, if we just reduce this statement into simple English, what they're saying is they're trying to create different products at lower price points, right? So they're trying to undercut competitors and create slightly different innovative products. One of the things that we have to think of as investors is not only are they going into new categories, the gross margin that we saw could actually be lower for these new products than for Britannia's traditional products, because they're pricing them at lower prices than their competitors, right? Anytime you lower your prices, your gross margins will come down. So as we think about the potential for Britannia to expand its margins over time, we've got to remember that they're also pursuing a low price strategy in their new product categories. Then on the dairy side, they said they're strengthening the core around cheese and dairy, but also expanding into milkshakes. So this milkshake category is also another one that they talked about as being a new product category. So we get a sense of what Britannia is trying to do here. So we're going to want to really understand these strategies and try and get a sense of whether we believe these will be successful or not. And no one has a crystal ball. I have no idea 100% if they're going to be successful or not. But my job as an investor is to take a guess, right? And if I feel an educated guess is, yeah, I like what Britannia is doing. They're making the right decisions. Stock looks reasonably priced. I think they can grow earnings growth pretty fast. Then maybe it's a really good stock to own. If on the other hand, you say, you know what, I don't think they're going to be able to crack into salted snacks. I don't think they're going to be able to crack the rural market in biscuits. You'll reach a very different conclusion. And this is the beauty of investing. All this analysis we've done, it just helps us ask the right questions. But at the end of the day, this is an art. It's about your judgments about these questions. It doesn't come down to a formula whether we invest in Britannia or not. It comes down to your judgment on whether it will be able to do these things it's saying or whether it won't, right? So that's why this is such a delightful activity, and also one that challenges you with every stock you pick. The last thing I pulled out was a bio of the leaders, right? Who are the key people involved in the company and what is their background? And I would not put too much stock in these bios. This was a check the box for me. I just wanted to make sure these were good managers, good chairmen, etc. And much more insightful for me is interviews with these people, because you can't get a sense of how they think by reading their experience set. You can just get a sense of, okay, this person looks credible. But really what's important to me and what you should factor into your investment decisions is, how does this person speak? Do you like his logic? Do you like his strategy? Do you like, the things he's saying? That's going to be much more impactful than this. Okay, so now let's recap our question list, see what we've answered, and add questions that still need answering. So I'm just reproducing our question list, right, from our last few sessions. And I've added some questions on the next slide that reflect new questions that I've had. And the ones in green are ones that we've answered through our comp analysis. The ones in black are still ones that we're going to want to dig into and understand further. So I'll just leave this on for a second so you can read it, and in the video, people can see it. And then we'll move to the next set of questions. And these are the new questions that I had. And we're going to again chip through these questions and try to answer them as best we can. So again, I'll just leave it up for a second so people have time to read it. Okay. So next time, what are we going to do? So we did a lot today. Thanks for hanging in there, and hopefully amidst all the technical issues and all, hopefully we get the YouTube video up there with no problems. But next time we're going to look at the quarterly press releases to update our numbers on Britannia. So all the stuff that we've done so far has been from the annual report. But the reality is 3 quarters have passed, or potentially even 4 quarters have passed since that annual report. And Britannia would have made press releases letting us know how they did in those quarters. So we'll need to get a sense of how they've performed in this year also. The reason we didn't start from there is there's very little detail provided in these quarterly reports. You always want to start from the annual report. They won't give you a sense of strategy. They won't give you a sense of who the company is, et cetera, et cetera. So we're going to do that in the next section, and we're going to try and chip away at these questions. And we're going to face a situation where, we'd love to know price and volume trends, but I've already looked in the annual report and it's not there, right? So there's going to be areas where we're not going to be able to know. So this is more like a wish list. We'll do the best we can with the question list we had. Great. And so with that, let's open it up for Q&A. I know we may...
So there are currently 2 questions.
Okay.
Should one spend some money and buy the products, taste them, and talk to your grocer and say, "Bikta hai ki nahi," when you're evaluating a company?
Absolutely. That is a wonderful way to get a sense of how the company is doing, how its products are perceived. And I used to do that all the time when I was studying sectors that were consumer oriented. So again, I think I talked about this in the past, but when I was analyzing grocery stocks, I would ask everybody I met, where do you shop for your groceries and why, right? And I would get a sense of how important price was to them, how important distance was to them, how important quality of produce was to them, and which brands they liked, which brands they didn't like, and it helped me a lot in my analysis. So doing exactly what you said is a very, very good idea. My only advice is don't rely on one kirana store when you go and ask. Ask maybe 10. And if you start seeing common themes arising from them, that is telling you something, right? So a kirana store guy will know pretty well how Britannia's salted snacks are selling, right? He'll know. Now, if you ask 10 of them and they all tell you that this product is not selling, that's going to tell you something very, very interesting, right? So that is a great strategy. Highly endorse it.
Okay, how important is looking at HR when you're evaluating a company?
So looking at HR is, I would say that it's important, but it's hard to evaluate culture of a firm from the outside without talking to people. So, and it depends business to business. So, there are firms that have had very poor work scores when it comes on HR metrics, as an example, that have been wildly successful. I'm not going to call out these companies because I don't want to talk badly about companies' work cultures, but there are plenty of these companies that have been very successful. So I would use it as a criteria, and also ask yourself, like, okay, uh, people are an input into a business, right? At the end of the day, how important are those inputs for the business you're investing in? If you're investing in a business where having high quality people, driven people, motivated people is disproportionately important, then it becomes critical. So an example of this is, if you're investing in an investment bank, as an example, investment bank's entire business model is finding very good, talented finance brains and getting them to give advice to people, right, and companies. So the quality of their compensation to their employees, how much they're paying relative to others, is a very key input. What their brand is compared to others is a very key input. But if you're, for example, an FMCG company, right, uh, HR may be less important in a sector like that. So it's very industry dependent. Key is, ask yourself, how important is the quality of people in what I'm investing in? And that'll be a good guide into how much you should be digging into HR. And how I would recommend digging into HR: look at the salary cost per employee, understand the option pool that the company is granting relative to the total market cap of the company, speak to people at the company, ask them what they think about it. Are people driven? Are they motivated? I would say that in general, I do believe that HR is underappreciated for most companies. So I would say that, yeah, so definitely an area you can look at.
All right, I don't think there are any more questions. You know, okay, there's one comment that came for chocolate croissants. Did they make a did they do a joint venture with a Greek company?
I'm not sure. I'd have to check the filing some more.
Okay. All right. I think this was really useful because everything's coming together now.
Yeah.
That's it for now, folks. The next session, I think, will be okay. There's one more question actually. How do you assess the quality of the management?
Very good question. So as I said, the bio is more a check the box. You want someone with credentials. You want someone that clearly, has some experience. But to me, it's overrated. I think much more important is, if you can look at interviews of the person on CNBC or on YouTube or whatever, and get a sense of how this person thinks, how they react to questions. That tells you a lot about the quality of a person's mind. When they're scripted, they can write anything they want, right? When you catch them on a question, right, that is random and spontaneous, how they react to that question, how they address it, how they answer it, how logical the thought process is very, very important to analyzing the quality of a management team. And, as small investors, we are not going to have the ability to just call up the phone and talk to the CEO. But now in the era of YouTube you can find so much content out there for, past statements that someone's made. So, and how they've responded to questions.
Okay, I think that's it for now. Thank you, everyone. And I think the next session is going to be uh, 2 weeks from now. Is that correct, Sahil?
No, the next session will be next week, but then after next week, we're going to go on a 2 weekly schedule, 2 weekly cycle, because we're going to have a beginner series 1 week and then the advanced series the next week. And also, I'm going to try and get another research paper out this week. So look for that at some point this week. And thanks a lot, everybody. And we are really coming towards the end, and hope this has been useful, and look forward to hearing your conclusions on whether you think Britannia is a good investment or not, because we're all going to come up with our own judgments, and it'll be great to get your thoughts also. Great. Thanks, guys. Bye.